Thank you very much for joining me in this video. Today I want to tackle the topic of inflation. Inflation can be your best friend or your worst enemy, depending on how out of control it is and how you position yourself. Some time ago, just before COVID, I was on a cruise out of Fort Lauderdale. We're heading down the coast to Panama and back. And we stopped in Colombia, and we stopped in Cartagena, great little town, walled village, enchanting. Thoroughly enjoyed spending some time there, but as I was walking around, a young man approached me and he was selling banknotes. He was selling peso currency, Colombian currency, that were basically worthless. He had 50, 100, 500, 1,000 peso notes that he wanted to sell to a collector who might be collecting them. And what happened was inflation got so out of control that these pesos were worth virtually nothing. It would take thousands of them to buy a cup of coffee. And yet that's where they were. And we see countries, Venezuela's example, I'm not necessarily picking on Colombia, or to a lesser extent, Greece went through these sort of things where inflation got out of control, spending got out of control, and it caused some serious problems with currency. On the ship I was at, there was a doctor who was from Colombia. And she told me that she was living in Colombia and she bought a house. And she said 2 or 3 years later, she sold it, and she sold it at a substantial profit. But she said the thing was, when I bought, it took 2,000 pesos to buy $1. She said when I sold, it took 3,000 pesos to buy $1. So she said all my profit was virtually wiped out. And then she had, it was really a good thing I bought some real estate. If I had just hung on to the money, I would have been in real trouble. So inflation can be terribly bad, but it can also be good. The Bank of Canada's targeted 2.5% is what they'd like to see for inflation. I endorse that. I think that's really, really good. I think we need to see some growth to feel like we're getting ahead. And let's suppose at 2.5% and with compound growth over a period of time, let's say the wages go up 50%. And they will. So if you're earning $50,000, maybe 20 years later, you're earning $75,000. And you feel like you're making some progress. The problem is that over that same 20-year period, the cost of goods and services have gone up 50%, so you really haven't gained any ground. But who's really been caught is the person who's at a fixed income. Some time ago, I was in a restaurant, and it was kind of a memory lane sort of restaurant, and they had old memorabilia on the walls, and they had a number of magazines that were from the 50s. And I was glancing through a Look or a Life magazine, and in that magazine there was an advertisement to invest in some kind of a annuity, and it said if you put in $12.50 a month every month, eventually you'll be able to retire, and I think it said with $23 a month coming in. That wouldn't buy you a coffee a day today. And so people who are on fixed income, some kind of a pension, fixed income, and it isn't at least indexed to the cost of living, they're losing ground and they're in real serious trouble. And so high inflation can cause them a lot of grief. But when we're looking at real estate and we're looking at, let's say, 2.5% inflation, over time, and it may be 20 years, it's going to grow by 50%. And I maintain that real estate will grow quicker than your cost of living index. And the reason for that is immigration and scarcity. They're not making any more land, but they're making more people. And so the demand is there in addition to your relative cost of living. But anyway, let's just deal with a 50% increase over time. We know that a house that you buy will double over time. And we've certainly seen that. Look at what your parents paid for the house. Look what it's worth today. And you can see that. But let's suppose it just stays abreast of the cost of living, and so the cost of living goes up, wages go up 50%, and the value of your house goes up 50%. So let's suppose you paid, I don't know, $400,000 for the house. And over a period of time, it increases in value, and it's now worth $600,000. That means your profit is $200,000, and that $200,000 is 50% of the acquisition cost of the property. But if you bought that property with 20% down and 80% of it came from the bank, that's what we call leveraging, then your investment is actually only $80,000. And if you look at the profit, you made $200,000 on an investment of $80,000, and that works out to 250% increase. And that's sizable. And that's the power of leverage. And you can do that because of inflation. And of course, with inflation, don't forget your rents are going to go up. And so all of your costs are relatively fixed. Your rents are going to go up over time, at least to keep abreast of the inflation. And so the cash flow is going to be enhanced. And one day the property is going to be paid off and you're going to have residual income. That's, of course, a totally different thing. But what I'm saying is that what you want to do is harness the power of inflation. And to harness the power of inflation, what you need to do is acquire an asset. It's a revenue-producing asset, real estate, and you need to leverage it with as little of your own money as feasibly possible. And then have the rent carry the mortgage so it services the debt, and then your return on investment is greatly enhanced by leverage together with inflation. Hope that makes sense. I want to thank you for investing the time. I look forward to talking to you again next session.